Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast. Now, I'm hoping the title has captured your interest, because it should. Because I truly believe, and I'm sure you'll agree by the end of the episode, that this is one of the most important podcasts we've ever created. And if you understand this week's episode, then you really do understand the wealth secret.
Welcome to the Property Podcast, where every Thursday property investors come to be informed and inspired. Such an important episode today. It may leave your brain hurting in places, but it'll be worth it, I promise, because the difference to your wealth from understanding this and acting on it or not is going to be dramatic. So make sure you do stick around to the end. And to reward you when you get that far, in Hub Extra, we've got a TV show that's going to help you relax a little bit.
So this week's news story comes from the FT, and the Bank of England are urged to spell out plans to curb inflation. Rob, this news story is very timely for us.
It is. We said last week that everyone was talking about inflation, and suddenly it's getting a lot of attention after being ignored for quite a long time. And indeed, the House of Lords have got in on the act. Their Economic Affairs Committee have been questioning the Bank of England and have said that it needs to provide a better justification for believing that the rise in inflation is temporary. And this story is actually the perfect bridge between last week's episode and this week's episode, because last week we were talking about all the temporary factors that are currently in place that are producing inflation right now, the kind of supply-demand imbalance that's caused for various kind of mainly COVID-related reasons. And those are the reasons that the Bank of England are saying, yeah, we've got inflation now, but don't worry, it's going to pass because all these factors are going to resolve. The House of Lords is less convinced, and they've said that the Bank of England has failed to justify its flagship QE policy. QE is something we've talked about on the podcast before, and it will come up again in today's episode. And they've said that the bank has become addicted to quantitative easing, using it as the answer to all the country's economic problems and facing few questions despite its eye-watering size. And the quote here is that there are risks given where the economy is that inflation could take off, and while the bank says it should be temporary, it should spell out the plan if it turns out not to be the case. So who's right in this news story? Are the Bank of England right to be relaxed, or is the House of Lords Committee right to be concerned? Well, you can make up your own mind after listening to this week's episode.
But before we dig into the topic of inflation, a little heads up for you. You may have been following along to our other podcast, Any Other Business. You'll find that in its own feed if you want to go and check that out. And if you have, you know that we've been teasing a major announcement. And actually, we've got a number of major announcements for the rest of this year. There's loads that is going to happen. The biggest things, by far, dwarfs everything we've ever done before, will be being announced this year. And in fact, it won't be just one announcement that's bigger than anything we've done before. There's going to be at least two, and then there's a number of other announcements you're going to want to hear about as well. So don't worry, we will keep you updated, but we know some of you love being first in line to get the information to understand what's happening, because sometimes it'll give you an advantage to take an action. So for those of you who do want to know what's happening first, then you're in luck. We're going to make it super simple for you. If you pick up your phone right now and text FIRST to 88802, that's it. Just FIRST to 88802, press send. Then you will be in line first, and you'll start to get exclusives and information before anyone else. And you never know, you might get an exclusive straight off the bat when you text in. So pick up your phone, type FIRST, and send that message to 88802, and you can be in the know, first in line to get all the announcements, all the information that we're going to start sharing soon.
So, last week on the podcast, we talked about inflation, and we focused on inflation over the short term. As we just recapped as part of the news story, we talked about how short-term inflation tends to be caused by a supply-demand imbalance. So if prices are going up, it's because you've got more people chasing a smaller amount of goods or services. And for various reasons, which we went into last week, this is where we are now. However, as we've also just run through in the news story, the Bank of England believes that this will correct itself and inflation will fall back down to the level that they want it. But before we can assess whether they're right or not, we need to understand longer-term inflation, because the dynamic that produces inflation over the long term is actually completely different from the one that operates in the short term. So in today's episode, we're going to focus on inflation over the long term. We're going to be talking about what causes it And importantly, for you as a property investor, we're going to be talking about the effects for investors in particular and what the coming years might look like in terms of inflation.
So to kick off, I think it's important that we all understand something, that we're all on this level playing field when it comes to understanding inflation. Because when you see your pint of milk or your car or whatever else going up in price, that is caused by the value of your money going down rather than the price of the goods going up. Your money isn't worth as much, so you need more of it to buy that good, service or product. Now, if you think about it, this is logical. If the value of money had stayed constant, wouldn't you expect goods to become cheaper to produce over time rather than more expensive? Because you become more efficient. Think about phones, how much better they are today than the ones we had in the past. Or computers, how they bring so many efficiencies to so much of our world. We're becoming more efficient, but prices are going up. But that's because your money is worth less than it was before. So why does this happen? Well, monetary inflation. Creating more of something reduces the value of each unit. So we've mentioned QE already, and we'll come back to it a little bit later on. But QE is effectively increasing the money supply. So if you keep increasing that money supply, then you get monetary inflation, and then the price of your goods go up because there is more money in circulation. Now, it's really important that you grasp this concept, because when you do, you kind of look at the world a little bit differently. But Rob, you've got a simple analogy to help the penny drop for those listening who haven't quite caught it yet.
Let's see if this makes things more or less confusing, because this is a really confusing concept to get your head around. You just don't think about the amount of money and the effect it has on prices. So let's have a go at this. And as I haven't had breakfast yet and I'm hungry, let's talk about food. Let's talk about a tiny, tiny economy that's completely closed to the outside world and has only a few things in it. It's got you, it's got 3 of your friends, it's got a pizza, and it's got 4 coins. Okay, so each of you and your friends have got a coin each. And there's also 1 pizza in front of you. So you could say that you each have 1 coin, so you're each entitled to 1/4 of this pizza. So if your friend was particularly hungry and they wanted to have your quarter of pizza as well, they would have to give you 1 coin for it. So you would have no pizza and 2 coins. You following along so far?
Yeah, but I'm starting to get hungry.
Yeah, same. So let's try and get to the end of the story quickly. So then imagine that suddenly a mysterious stranger comes along, gives you each an extra coin, and then disappears again. So now there are 8 coins, but you've still got the same pizza. At this point, if your hungry friend still wanted to get their hands on your quarter of the pizza, how much would you charge them for it? Well, given that there are 8 coins in the economy and you've got a quarter of the pizza, you'd want to charge them 2 coins, wouldn't you? So because the amount of money in this weird economy has just doubled, it's effectively doubled the cost of each slice of pizza. So nothing's changed, no one's created anything, no one's got any more, but because the amount of money has gone up, the cost of the pizza, the goods in this economy, has gone up. And that's exactly the same as what happens when money gets printed. Of course, you don't go and double the amount of money, but the effect is exactly the same. And of course, in a real economy, there's plenty of other things going on as well. So I'm not making like a strict monetarist argument that money is the only cause. But hopefully that analogy explains why the amount of money is a very important factor in prices and does go a very long way to explaining this weird phenomenon whereby the price of things goes up over time. As you've already said, Rob, that's not the case. The actual goods are not getting more expensive. It's that the money, because there's more of it, is getting cheaper.
Let's bring this back to the real world, the real economy, where more money is created every year. But that's not actually always been the case, because it really kicked in from when the gold standard ended in the 1970s. The gold standard was when the government used to have a certain amount of gold in its possession to create additional currency. So if you wanted more currency, you needed more gold. And it just meant that governments around the world couldn't just print and print and print as they chose. The gold standard, or what was left of it, was removed in the 70s by President Nixon. And because the dollar is the world's currency, it meant that effectively America removed the gold standard for everybody. So let's have a look at this in practice before and after the gold standard. So if you had £100, we went back in time to 1837. So we're going way back in time, you got £100. You're pretty well off with £100 back then. But because inflation wasn't really in play, if you then went through all the way to 1914, so from 1837 to 1914, how much buying power does that £100 have? If there's been inflation, then the buying power of that £100 would be a lot less. But because there wasn't inflation, or the inflation was minimal and balanced out over time, then actually you'd have the same buying power. So the amount of goods and services you could purchase in 1837 with £100 was pretty much the same in 1914. So a large period of time has passed, but yet your money is valuable as it was before.
Okay, so let's fast forward a bit more. So you're in 1914 and you've got your £100 still. What would that be worth if you held it through to 1950? What would your buying power be? Well, even though over the previous 50 odd years, the buying power hadn't declined at all, between 1914 and 1950, your £100 buying power would have declined to £30. So 2/3 of your buying power would have been gone between 1914 and 1950. Why is that the case? What was going on between those years? Well, a couple of pretty big wars was what's going on. And as a result, loads of money was created. And as a result of those wars, loads of money was created. The gold standard was actually suspended temporarily, and lots of other things were going on that allowed governments to create lots of money. They had to. Wars are expensive. You can't just save up for a war. You can't suddenly have a whip round when war breaks out. You need to print a load of money. And that's what they did. As a result of that money creation, 2/3 of buying power gone in such a short space of time.
So let's look over a longer period. Let's stay at 1914. We've got £100. You have the money creation from the wars. Then you have the gold standard. And then, as we've said, the gold standard ended in the 70s, which led us all the way up to today. So your £100 in 1914, what would it be worth today in real terms? What could it buy for you? What is your buying power? Well, your £100 in 1914 is really only worth today in buying power 85 pence. That's a 99% loss of purchasing power. So if you kept that money under the bed in 1914 and waited all this time, then in reality, you'd only have 85 pence today. So if you had £100 worth of buying power in 1914, today it would only really be 85 pence. Because remember, you didn't have £100 in 1914, you had £100 worth of buying power. But Rob, that's from 1914 till today. So you can go, okay, well, 99%, it's been over 100 years, fair enough. But actually, if you look at shorter time periods, because of quantitative easing and the aggressive nature of QE, it's actually quite shocking, the numbers, even if we take a short period of time.
Yeah, we've thrown around some numbers which are really shocking. These aren't controversial numbers, by the way. These are from kind of publicly available data. And they are pretty shocking. But actually, you don't have to go that far back in history to get a shocking number. This is the one that surprised me most of all. Let's just take the last 20 or 21 years. So you've got £100 in the year 2000. That doesn't feel like very long ago, because it wasn't. How much buying power would that £100 give you today? The answer is £56. So nearly half your money has gone. Half your buying power has been wiped out in 20 years. And I think because it's the most recent 20 years, it feels more real. It's not like you're going way back in time and going, oh, what would have happened back then? You've lived through this happening. If you had £100 sitting in a wallet that you've sort of lost down the back of a set of drawers and then you found it again, that's going to buy you pretty much half as much as it would have done in the year 2000. And that is purely because of inflation. And the reason for that inflation, in large part, is the amount of money that's being created every year. In part, but only in part, we'll come to this later, because of QE, which is something that has only really been a thing for the last 14 years or so.
So before we move on, to really help this sink in, let's compare it to gold, because we talked about the gold standard, and the reason the gold standard was in place is because only a small amount of gold is discovered each year, is mined, so it holds its value far better. So let's look at the value of gold in the past, and let's have a look at the value of gold today. Well, the average house price in pounds has increased 100-fold since 1952. So you often hear that property goes up in the long term. Well, there's your number that proves it. It really, really does. But that's if you measure it in pounds. But if you bought with gold in 1952, how much gold would you need today to purchase property? Well, exactly the same amount of gold. Because gold hasn't suffered against inflation anywhere near as much as money. So gold is a steady asset. And that's why you often hear people go, well, gold is a hedge against inflation. And that's why people who've acquired some wealth often will have gold as part of their overall financial portfolio. It's not necessarily there to help you increase your wealth, but it's there to help you protect your wealth. And Rob, those numbers that we've talked about and then comparing it against gold really demonstrate that just holding money is an absolutely disastrous thing to do.
Exactly. But in reality, we have to use pounds. You don't get too far going around trying to offer people gold for their goods and services. So pounds are what we're stuck with. And by the way, the pattern for the dollar is almost identical. This isn't just a pounds thing. This is happening pretty much everywhere all the time. So what are the consequences? Well, we can break down the consequences into what it means for consumers and what it means for investors. Because if you're listening to this podcast, you're at least one of these and probably both of these. So let's look at the effect it has, starting with consumers. If you are merely a consumer and every year the price of everything goes up, but your wages go up as well by the same amount and you spend everything that you earn, then inflation doesn't really make any difference. So everything costs more, but you get paid more and you're not saving anything. So at the end of every month, you end up in exactly the same position. Your living standards aren't affected one way or the other. However, if you do attempt to save anything, you'll get punished for that. Because assuming the rate of interest you get in your savings is lower than inflation, as we've seen, that cash that you're holding becomes worth less over time. We've talked so far in this episode about it's like leaving cash under the mattress or something. But if you didn't do that and instead you put it in a bank account that was paying interest equivalent to the rate of inflation, then you would, again, not be losing out. Everything would be going up by the same amount. But in reality, ever since 2008 or so, interest rates have been held below the rate of inflation. So it's impossible for your cash savings to keep up. They will lose value over time. And that means it's hard to save for the future. And it's hard to save up to pass something on to future generations because the money that you've saved is always becoming worth less. If you'd made a will in 1914, leaving someone the equivalent of £100 worth of buying power and left it for your great-grandchildren or whatever, then they'd be very disappointed to find out all this time later that that's worth about 85p to them. They wouldn't think that you were that generous. But that is the effect that inflation has for people who are trying to save. And as a result, Rob, the only thing you can do is invest. You have to try to invest to earn a return that outpaces inflation. Otherwise, you're losing out.
So let's look at the effects of long-term inflation for investors in general. Well, your assets go up in value, or rather, they benefit from the pound falling in value, unlike cash. And now let's look at property investors, how they really benefit. Because if you have a mortgage, you get the inflation increase on 100% of the property's value, even though you've only put 25% of the money in. So that's great, right? Well, it gets better. Because the 75% left that was debt falls in value as well. So your mortgage gets paid down in real terms. So inflation drags down the value of your debt, while the asset that you've purchased with only 25% cash increases in value because of inflation. So it's like this double whammy that's at play that is so powerful for property investors. And that's why people who invest in property have done so well over the long term, because over the long term, as we've heard, inflation really does take hold, and particularly more recently. So investors are really rewarded by inflation. But of course, conversely, savers, as we've heard, are really punished. So this lesson of make sure you save is a load of codswallop. Saving is rubbish. You save to invest, because if you just save, you're going to get poorer. But if you invest, and invest wisely, you can really benefit from the effects of inflation.
So when we've been talking about inflation so far, and all the figures that we've been quoted, we've been talking about consumer price inflation. We talked about this last week, but it's the average change in price of a basket of goods and services that consumers would buy. So if your assets perform in line with that general rate of consumer inflation, then you benefit for all the reasons that Rob's just run through, especially if you're using debt. However, as we also mentioned last week, asset prices are not included in the consumer price index. So the prices of things like property, gold, stocks, bonds, things like that, those financial assets are not included in the consumer price calculation. Therefore, the rate of inflation of those prices, those assets, could be completely different. So if those assets are going up faster than general inflation, then you get all the benefits that Rob's just run through. And this is where we start shifting from the theory of inflation to what is happening right now. Because over the last decade or so, there's not been that much in the way of general consumer inflation. There's still been enough that over the long term, it's going to very much hurt you if all you're doing is having cash under the mattress or indeed in the bank. But the rate of inflation has not been extreme by historical standards. However, asset prices over the last decade or so have absolutely exploded. And it's worth understanding why that's the case, because then we can judge whether or not that's likely to continue. So let's look at some of the reasons for excess asset price inflation. The first of those reasons is low interest rates. So after 2008, the interest rate absolutely collapsed down to almost nothing, and it stayed at almost nothing ever since. That has affected the price of virtually all assets, and it's affected them all in different ways in terms of the mechanism by which it's caused prices to increase. But the result is that prices have increased for pretty much any asset you can think of. It's happened for gold, it's happened for bonds, it's happened to stocks, and it's happened to property. I said earlier that consumer price inflation over the last decade had been pretty moderate by historical standards. That's not been the case for asset price inflation. All those assets I just listed, their prices have gone way up. And a large part of the reason for that is the falling interest rate. But that is only one of the reasons.
So we've mentioned QE a few times in this episode already, but it's so important and there's a real reason for it, because QE, quantitative easing, is the increasing of the money supply. And we've talked about how money supply in general causes inflation. But it really impacts assets beyond just extra additional currency in circulation, because it's how QE is mostly used that really impacts asset prices. Because up until recently, QE has been used, quantitative easing, that additional money supply, has been used to purchase bonds. So often, bonds will be a safe haven for investors' funds. They'll put their money into bonds. But by the Bank of England and other central banks around the world purchasing bonds, it means that the returns of those bonds have really collapsed. They don't offer a return. Inflation often will outstrip the rate that they get from a bond. So it forces investors and institutions into investing in different asset classes because bonds have become so unattractive. So what do they purchase? Well, they purchase companies, stocks, and of course property or real estate, depending on where you are in the world. So because that money is being used to buy those assets and money is being driven to buy those assets, then it's this double whammy of QE. There's more money in circulation, but a lot of that money is being used to go and purchase more assets. Because bonds, traditionally a safe haven for large sums of money, are just offering nothing right now. So it's really exacerbating the problem, or for property investors, the opportunity, because it really drives asset prices up.
And then the final reason why asset prices have been outstripping increases in consumer prices is that, like I said earlier, consumer prices are an average of all different types of goods and services. And there are some types of consumer prices where there are actually deflationary pressures. So if you take anything related to technology and digitization, that pushes consumer prices down. So the price of phones and TVs is way down on where it used to be. You can get something far better at a far lower cost. Even if you look at things like music, I mean, you might have previously gone out and bought a load of CDs every month, but now you make one single payment to someone like Spotify and that's you sorted. So that's reducing prices there. Instead of paying a load of money to go to the cinema, maybe you just use Netflix or something like that. So there are whole categories of consumer prices where the effect is actually deflationary rather than inflationary. And that, of course, drags the average consumer price inflation down. But that doesn't apply to asset prices. There are no deflationary pressures in the world of asset prices. Therefore, you'd expect them to increase at a higher rate than consumer prices. And that is exactly what's been happening. You can't just digitally create a whole load of extra property, and you can't start buying your property in from another part of the world where it's cheaper to produce it. Therefore, there are none of these deflationary pressures to offset the inflationary pressures that we've just been talking about. And as a result, asset prices are way, way up.
At the beginning of the show, I said this might be one of the most important podcasts we've ever created. And I think you can understand now why I said that. If you get this, and I mean really get it, then you've got the code for long-term wealth. If inflation stays, both short and long, then you know what to do to become wealthier. You now have the tools, the information to do what the world's most wealthy investors do, the most powerful investors do. You have the same core knowledge now. If all of this is sunk in first time around, then congratulations to you. This is a complex subject. But for most people listening, you probably want to go and listen to this again. But to summarise, short-term inflation is bad for savers and it's good for investors. But long-term inflation is the real story here. That's where the real wealth is created. And we've heard how property prices get that double benefit from inflation because you don't have to put as much cash in to buy the asset, and the rest of the cash you use, debt, is eroded by inflation as well. So you get that double whammy, that win-win. Now, while you may be feeling excited right now, and that's great, I'm glad you do, this for me is bittersweet because the thing with inflation is most people across the planet are going to get poorer because of this, because most people don't understand what we've talked about today. And there are different ways of running the world and the economy that could possibly change this. Now, is that likely to happen in the short term? No. But that will mean that wealthier people will become wealthier and richer, and poorer people, unfortunately, will become poorer. There's going to be that inequality, and that wealth gap is going to increase. And I don't think that's a good thing. But what we do here on the podcast that I think is so important is that we teach you that it's unfair, and then you can decide which side of the fence you sit on. It doesn't mean it's fair, it doesn't mean it's right, but if at least you understand the rules, at least if you understand the game that we're all playing in, you can benefit yourself, benefit your family, and tell more people about it. This is a podcast that you should share. It's so important that people understand this concept. So please do share it. And at least you can say to people, hey, there's a lifeboat here. It's up to you if you want to jump onto it. But if people don't even know there's a lifeboat out of this situation, then what can they do? You're not helping them. So share this podcast, help people understand what is happening, and then you can sleep a little bit easier at night that you've passed the message on as well. Helps us sleep at night that we're telling as many people that what is happening, and then hopefully you, your friends, your family, and others that they pass it on to will benefit from this information as well.
Well, every week before we wrap up, we bring you Hub Extra. It's where we squeeze in that little bit more, whether it's a resource, a tool, a book, something to think about, whatever it is, we bring it your way and we back it up with the Hub Extra newsletter, which will reach your inbox if you're a Property Hub member, and it should be, it's free, every Friday morning. And today's episode has not been the lightest we've ever done. Maybe your head's spinning a little bit and you just need something entertaining that you can watch to turn your brain off for half an hour or so in the evening. Well, if that's the case, then we've got a great resource for you today.
It really is one of those shows that you're not going to do a lot of thinking, but you know what, you can enjoy it. It's called The World's Most Amazing Vacation Rentals, and it's on Netflix. So if you search for that, you'll find it. Obviously, Netflix knows me and understands me, and it recommended this show to me because I love vacations, or holidays as we call them in the UK, and I love property. So this is the perfect combination. And they go around the world looking at different vacation properties that you can rent for yourself. If you have a holiday rental investment strategy, then you might learn something from it as well. But if you don't, I don't, but you just enjoy looking at beautiful properties in a beautiful setting and think about possibly visiting some of them, then it's a great way to spend half an hour. One of the hosts is from The $1 Million Listing, Luis. If you watch that show, it's one of our guilty pleasures that we also watch. So there's another recommendation. If you've not watched The $1 Million Listing, that's very good as well if you want to switch off. But this is a really easy watch. It's on Netflix. Check it out if you fancy a little escapism.
Well, there you go. That is us done for this week. That is a heavyweight property podcast, but an important one. As Rob said, if you didn't fully grasp everything, it's well worth listening for a second time round, because this is probably the most important concept you can possibly understand as a property investor. But it's also very important to know what's going on in the market right now, and that's what we're going to be covering next week on the podcast. Yes, it is time for our market update. We're going to be back with that next Thursday, and before that, we'll see you on Tuesday to answer another couple of your questions. So we'll see you soon. Bye-bye.
Bye-bye.